Imagine that you want to save and invest in the stock market, but you have absolutely no idea how to do it. Or you don't want the hassle, and you want a system that does everything for you automatically. Something you can set and forget until retirement age. Target date funds are one of the simplest and most common solutions to this need because the asset allocation within fund starts with riskier and better performing assets when you're young, like equities, and shifts little by little to more stable investments like bonds and cash the closer you get to retirement, making the portfolio more stable and less volatile. In this video, I'm going to explain everything you need to know about target date funds, otherwise known as target retirement funds. We're going to discuss what they are, why you need them, how to invest in them, and so much more. And next week, I'm also going to publish a comparison between target date funds and the glorious S&P 500 index. My name is Rick, the Italian twin of Manu Ginobili. If you're new here, you're very welcome to subscribe to the channel, and now relax because after this video, you'll know everything about target retirement funds. First of all, what are target date funds? Target date funds, or TDFs, have become an increasingly popular investment option in 401k plans. So if you have an employer-sponsored account like a 401k, chances are you have already heard of the target date funds and want to know something more about them. Before the 1980s, 401ks weren't really a thing. People used to have so-called pension plans, which were completely managed by employers and guaranteed the retiree a set payment for life. 401k plans started getting traction in the 1980s and were marketed as a great plan that allows employees to have much greater control over their retirement savings. Now, greater control can be a good thing because you can finally decide where your money is going instead of being completely dependent from an employer. But it's also a challenge because you need to know exactly what you're doing. So target date retirement funds, or TDFs, became more and more an attractive investment option for employees who don't want to actively manage their retirement savings. In fact, TDFs automatically rebalance their assets to become more conservative and safe as you get closer to retirement. The target date refers to a target retirement date and often is part of the fund's name. For example, you might see target date funds where the name includes Portfolio 2030 or Retirement Fund 2030 or Target 2030. These are designed for individuals who intend to retire during or near the year 2030. The way they work is that they hold a mix of stocks, bonds, and other investments that automatically changes over time as the participant ages. This mix of stocks and bonds is called in financial terms asset allocation. And the fact that it changes over time offers investors a great long-term investment strategy. If you are, for example, 27 years old and you plan to retire in 40 years at the age of 67, you would buy a target retirement fund with target year 2065. Since you still have many years of work in front of you, the initial asset allocation will consist mostly of stocks or equity investments, which have greater potential for higher returns, but can also be more volatile and risky. Then, as the target retirement date approaches, the fund's asset allocation is going to shift more and more to conservative investments like bonds and cash instruments, which generally are less volatile and carry less investment risk than stocks. The shift in the asset allocation over time is called the TDF's glide path. It's important to know whether a target date fund's glide path uses a to retirement or a through retirement approach. A to retirement approach reduces the TDF's equity exposure over time to its most conservative point at the target date. A through approach keeps reducing equity exposure even for a number of years after the target date. So we understood that the goal of these funds is to bet on riskier assets earlier in the investor career in order to get higher returns when there is still time to recover from potential market declines. Then, as retirement gets closer, the investment accumulated over time are protected from market volatility through the use of bonds and other conservative investments. But you could wonder, if riskier assets give you higher returns in the long term, why shouldn't you just keep your money investing in these assets even when you get older? The reason has to do with the so-called sequence of returns risk. The sequence of returns risk means that it's not all about the average long-term return, but also about when these returns exactly happen. Assume, for example, that you have a portfolio of $1 million that generates 10% return per year for a time frame of 10 years, except for 2 years in which it crashes and loses 50% per year. Now, I want you to imagine two different scenarios. Scenario A, the portfolio returns 10% per year except in the last 2 years, where instead it loses 50% per year. Scenario B, the portfolio returns 10% per year except on the first 2 years, where instead it loses 50% per year. And the final value of the portfolio is going to be exactly the same, $535,897. But if you're retired and need to withdraw money every year for your living expenses, then the sequence of the returns becomes important. Let's say, for example, you withdraw 4% of your portfolio, so $40,000 in the first year, and you adjust it for inflation. Namely, you withdraw a little more every year to account for an average inflation of 3%. If the 50% drop happens in the last 2 years, after 10 years, you're gonna have a portfolio of $359,348. If it happens in the first 2, after 8 years, you already ran out of money. So that's why most advisors preach the importance of investing more and more into bonds the closer you get to retirement. It's not about long-term growth anymore, it's about preserving what you already have. Bonds give you a lower average return, but are also less volatile than equities, reducing the sequence of returns risk and allowing you a safer retirement without surprises. Now, most investment retirement firms offer target date funds. Besides Vanguard, Fidelity, and Schwab, others include TIAA, BlackRock, State Street, JP Morgan Chase, and many more. To give you an example of real existing target retirement funds, let me show you the ones available from Vanguard. As you can see, there is a target retirement fund for every 5 years. So for example, if you plan to retire in 30 years in 2054, you would choose the Target Retirement 2055 fund. You can see it has a cheap expense ratio of 0.08%. And if we click on it and go to portfolio composition, you see it's composed of 4 elements: the total stock market, the total international stock market, the total bond market, and the total international bond market. Right now, the percentage of bonds is less than 10%. As time passes and you get closer to 2055, the percentage of the 2 bond index funds increases and the percentage of the stock market components decreases. At Vanguard, the funds have a glide path through retirement. Namely, they continue to adjust for approximately 7 years after your retirement, until their allocation matches that of the Target Retirement Income Fund. The Target Retirement Income Fund is the one at the end of the Vanguard list of retirement funds. And if we click on it, we can see how the final portfolio 7 years after retirement is going to look like. You're going to have 69.45% in bonds, 0.74% in short-term reserves, and 29.81% in stocks. Now, I just want to show you another example so that you have a complete understanding of Vanguard target retirement funds. If we go and look for one that has a target date that is coming soon, or for example has already passed, like this with 2020, we should expect a current composition that is similar to the one of the reference target retirement income fund. If we click on the portfolio, you can see in fact that the fund has 60% in bonds, which are still going to go up to 69.45% before 2027. Now, target retirement funds have several benefits and risks compared to investing yourself in the stock market. One of the main benefits of target retirement funds is convenience, because the asset allocation happens automatically. Another benefit is simplicity. Since target date funds tend to be broadly diversified mutual funds, they can be considered a single investment vehicle that is going to be perfect for you from when you start investing until after retirement. Benefit number 3 is that risk tolerance is factored in, for the simple fact that some target date funds allow investors to specify their level of risk tolerance and adjust the glide path accordingly. And the last benefit is the long time horizon, because by definition, target date funds are created thinking about the long term and get rebalanced over time. All this convenience though comes with a price. The first price that you pay is an actual price, and it's the fees. Many target date funds that are offered in 401ks are actively managed. Namely, there is a fund manager that actively manages the fund. This usually makes the expense ratio and the fees of the fund really high, even at 1% or more. The second problem with target retirement funds is still related to the yearly fees, and it's the fact that you pay fees twice. You pay the fee on the target date fund and also the fees of the funds included in it. Another problem, or better said, risk, is that there is no guarantee of success. Target date funds adopt a more conservative approach compared to standard investments, but still, there is no guarantee that it will successfully protect your retirement savings at any point. The last risk that I want to mention is the fact that even if you buy a target date fund with a target in 30 years from now, you get a fund that already has a portion of bonds. This might not align with your investment because if you're young, you might want to focus 100% on equities that are by far the best performance compared to bonds in the long term. A common misconception about target date funds is that funds with the same target date but offered by different providers like Vanguard and Schwab are the same. Instead, individual target date funds will hold different allocations of assets, and the assets themselves are likely to also be different. Another misconception about target date funds is that the work they do for you is tedious and it's worth the higher fees. Well, it's not always like that. In most cases, target date funds are actually based on 3 or 4 funds that you could actually purchase yourself, and the allocation is changed once per year. But nothing stops you from buying the funds yourself and rebalancing the portfolio within 10 minutes of work every year. For example, if you were to invest using the famous 3-fund portfolio, which is composed of 3 funds, a US stock market fund, an international stock market fund, and a bond fund, rebalancing the fund every year would be extremely easy. And I prepared this file for you that I make available for you completely for free, and you can download it from the description below. If you want to know how to easily use this file to rebalance your portfolio, you'll find all the information you need in this video of mine. And I'll link the video here and in the description below. Alright guys, let me know what you think about target date funds, if you use them already, or if you use a different portfolio like the 3-fund portfolio. Don't forget to download the file that I mentioned for free and subscribe to the channel so that you'll be notified of future videos like this. Thank you so much for watching guys, I wish you a great day or evening, and as always, I'll see you in the next video. Ciao!